Okay, so I'll start already by presenting a few of our key findings and then dive deeper into the methodology and all of the results. So basically, our key findings are that, first of all, female traders have a preference for momentum stock. Also, women are more prone towards the disposition effect than men. Then we've also found that female trading has a higher correlation towards future asset performance than momentum trading in general. So if we take the whole client database and test the correlation towards asset performance, it's of lesser value than simple female momentum trading. And then last, we find that women are able to generate higher returns than their male counterparts. So the purpose of this study is to observe the differences in investment style between men and women. Further, we studied the impact of female momentum trading because we find that females tend to trade momentum on future asset performance. And then last, we ask ourselves the questions, so do female or male traders perform better? A quick literature review just before we dive in deeper. So first of all, the fact that female traders are more prone towards disposition effect was already hypothesized by Sheffrin and Stabman. We further test this hypothesis and find that it corroborates with our findings. Then previous studies have already shown that female traders outperform their male counterparts. So for example, Liu and Swan have shown that female traders were able to generate a lot higher profits than male traders. And then last, since we are studying momentum trading, an interesting finding was, for example, by Jagadish and Titman, that past winning stocks over, for example, the past prior 6 months still tend to outperform past losing stocks for the next 6 months, 6 to 12 months. Just a simple explanation of our data. So basically, our data comes from one of the biggest trading retail platforms in Switzerland. They have around 90,000 clients. And so we study a time frame of around 10 years. There's been approximately 2 million trades performed during this time frame, and approximately every client performs around 10 trades per month. And the average number of trades per month is around 7,000 in total. And last, gender composition, there's around 12,000 women in our data set and around 80,000 men. So it is known that the finance industry is a generally male-dominated industry. So that is not very surprising. So moving on to the hypotheses we test. So first we start by testing, do women actually favor momentum stock? Just to briefly introduce why we decided to test this hypothesis. So previous studies have already shown that female traders tend to be more risk averse than male traders, which is why previously we decided to conduct an experiment. It was on a very short data set, like around a year, to see if that would mean that basically maybe women also buy stocks that perform better because they see some sense of security in them, which then further on led us to try testing this hypothesis on longer time periods to see if it actually still holds or if it's just if it was just over 1 year. And next, since we are testing whether they like buying stock that has had a good past performance, we also decided to test whether they sell stocks with good past performance. So test if they are prone towards the disposition effect. We do not test if they hold capital losses for too long. We only test for the disposition effect on whether they sell capital gains. Last, since after testing whether women do favor momentum, we wanted to see how it affects future asset performance. So if this trading strategy used is actually effective and actually generates profit. And last, we wanted to compare who comes out on top, male traders or female traders. So for our first results, we use regression. So basically, we regress on buy characteristics of female traders base their buy decisions on. So as you can see in the table, we use past returns over 250, 70, and 25 days, as well as standard deviation over 250, 70, and 25 days. And we observe the beta coefficients to see if there's a positive, negative correlation, if it actually has value. And as we can see in the results, the beta coefficient on past returns over 250 and 70 days is highly statistically significant and positive. So we do find a positive correlation between female buy decisions and stocks that have had a good past performance, which is why we concluded that female traders favor momentum stock. We do observe a mean reversal when looking at the coefficient over past returns over 25 days. This may mean that, for example, they consider that the stock is not stable enough, or maybe the returns have only been good for the past 25 days, and then it's going to go down. And last, as we can see, most coefficients on standard deviation are negative and statistically significant, which just shows that female traders are risk averse, which is a hypothesis that has already been shown by a lot of previous studies. And yeah. And then again, moving on to sales, we see, again, we are able to observe mostly negative coefficients on stock with good past returns. So we hypothesized that, for example, when the returns have been good for 250 days, female traders tend to sell that stock, maybe because they consider that there's going to be a reversal, and that these prices have already been going up for a certain amount of time, and which means that consequently they will be going down from there. And over 25 days, maybe because they consider the stock to be too volatile, or but since they usually don't really buy stock that has had a good performance over 25 days, we don't really conclude anything on that. And then, as we can see, the relationship between most coefficients on standard deviation and sell decisions are positives, which again leads us to conclude that they tend to sell when a stock gets too volatile, when there are big price moves, probably due to their risk aversion. Next, we constructed basically female and male attractiveness measures towards a stock. So to be able to see how the stocks that men and women buy a lot performs. So these measures are basically, as you can see, the number of women that have bought a stock in a month T divided by the total number of women that have bought some stock in month T, and then the same measure is constructed, but using the number of clients that have bought some stock in month T. And we construct the same measures for men, and again, the same measures will be constructed for sales, and further on used in our regressions to be able to test for correlation between asset performance and an attractiveness, if we can say so, of a stock to men and women. To test for correlation between asset performance and female or male buy trades, we use, first of all, we again use the standard deviation and past prices to see if this has an impact on future asset performance. Then the coefficient on female attractiveness of a stock, we test for the significance and value of beta on this coefficient to see if this relationship is positive or negative. So to see if whether a stock that a lot of women buy performs well or badly in the future. And then we also test this interaction effect between past returns and how attractive a stock is to women, or again, the same calculations are performed for men. This leads us to the following results. So as we can see, most coefficients, so for example, if we use how attractive a stock is to women compared to the female client database, we see that most coefficients on the interaction effects between the attractiveness of a stock to women and past returns are more significant or of higher value than simply on past returns. So this again, one of our key findings was that the trading activity of a certain group, so here we divide it into men and women, it has actually a higher correlation to future asset performance than simple general momentum trading. And our most interesting finding is this coefficient on the interaction term between past returns over 70 days and this attractiveness measure. And this coefficient is really high, so of the order of around 2, and highly statistically significant, which means that women that trade stock that had a good performance over the past 70 days should experience really high returns on the stocks they buy. Similarly, for men, the findings are around the same, using the same attractiveness measures. So how many men buy a certain stock divided by how many men in general have bought stock in a certain month T. And again, the coefficient is really high, so the order of 1. So it's twice less magnitude than the one for women. So first of all, what do we conclude from that? Is that female trading actually has a higher correlation to asset performance than male trading, but male trading also has a higher correlation towards asset performance than general trading activity. And we see that both these coefficients are highly statistically significant and positive. Then again, there's also negative coefficients. If we look at the coefficient on the interaction term between the past returns over 250 days and 25 days, we get negative coefficient, which means that, for example, maybe for 250 days, there's been a price reversal and prices are going down. We don't really pay attention to the one on 25 since women don't really buy stock that's had a good performance for the last 25 days. But again, maybe this has been a too short time frame and leads to bad returns. Another interesting thing is if we compare the attractiveness measures, so women to total clients and men to total clients, as we can see, most coefficients on the interaction terms between the female attractiveness measure score and past returns are positive, whereas for men it's negative, which leads us to conclude that women, compared to the whole client database, stocks that are highly purchased by women compared to the whole client database should experience good future returns, whereas stocks that are highly bought by men compared to the whole client database should experience lower returns, which would lead us to conclude that probably women outperform men here. Next, we test the same, basically it's the exact same regression, but this time we're using the sale measure attractiveness, so stocks that are highly sold by men and women. And here what's interesting, again, is that we find a positive relationship between the interaction terms between most past returns and how highly a stock is sold by women and by men compared to their respective groups, so women and men, which leads us to conclude that here both are actually prone to the disposition effect. So both seem to be selling stock that will experience good future returns. But contrarily, if we compare to the whole client database, so we use the same measures, but for men and women, but compared to the client database in general, we see that most coefficients under interaction terms with the female attractiveness score is positive, whereas for men it's negative, which does lead us to conclude that women seem to be more prone towards the disposition effect than men, since men do seem to also be selling capital losses, whereas women seem to be selling more capital gains. I'd like to highlight here that this does not specifically mean that it doesn't have to be a bad thing. Maybe it just simply means that the female trader has decided that she has made enough profit, and then it's the moment to perform a sale, that and not simply she's selling due to some other factors. Maybe it's an actual it's an intelligent decision and not simply due to the risk aversion. Next, we decided to create a synthetic dollar neutral portfolio, basically to test the performance of female and male trading strategies. So using basically signals, as is explained here, we computed weights using the 20% of worst stocks and 20% of best stocks. And so the whole point is going long on the 20% of best stocks and shorting 20% of worst stocks, and then testing the performance of this strategy. So we create these synthetic dollar neutral portfolios for the male trader group and for the female trader group, and then we compare to see which portfolio performs better. First, we started by computing the Sharpe ratios in each year of each of these respective portfolios. So please disregard the results in year 2010 because they're obviously skewed. The numbers are way too high, but if we then compare in general, so we use Sharpe ratios, for example, using these attractiveness scores, the mean attractiveness scores. It all figures in the paper. It's a very long methodology. I decided not to explain all of it during this presentation. It take a lot of time. But basically, if we compare, so for example, S1 Fem, S1 Men, it's the same. It's using the same attractiveness measure of a stock. We can see that in general, Sharpe ratios for women are higher than Sharpe ratios for men, which does lead us to conclude that female traders perform better. I like to highlight the fact that there are negative Sharpe ratios, and that is due to a commonly known fact that individual investors do generally suffer losses. And I mean, no matter their gender group, even if women outperform men, they still seem to be suffering losses. We then test the performance using the Fama-French three-factor alpha regression. So as you can see, using the usual coefficients, so high minus low, small minus big, market-free rate. And then we observe the statistical significance of the coefficient on the attractive measures of a stock for men and women, to test if whether being female or being male makes you perform better or worse. And here the model was not very successful in finding statistically significant results. So these are sadly the only statistically significant results we were able to find. The rest does not give something that is interpretable. So as we can see, the coefficient on the female attractiveness measure indicator is positive, and for men it is negative. These are, just to remind, these are the coefficients. So it's number of women that have bought a certain stock in month T divided by the whole client base, and for men the same. So as we can see, being female actually is positively correlated to asset performance, whereas being male is negatively correlated to asset performance. And then last, we regress simply future returns on attractiveness measure over stock to women and to men. And here we find, so if we look at measures of women compared to women and men compared to men, both give statistically significant positive results. So from that, we conclude that compared to their respective gender groups, stock that's highly bought by one or the other should perform better. But the performance gap really appears when we look at women compared to clients and men compared to clients, where we are able to observe a positive coefficient for women and a negative coefficient for men, meaning that a stock that is highly purchased by women compared to all clients should experience a good performance, whereas a stock highly purchased by men compared to all clients should experience a negative performance in the future. So to summarize, we've built a model which demonstrates, in accordance with empirical findings, that women seem to be favoring momentum stocks. Female traders are more prone towards the disposition effect than men, but men are still also prone to this complication. Then we have found that both female and male trading activity has a higher correlation towards asset performance than general momentum trading. This is probably the most interesting one of our findings, since the fact that momentum trading predicts future asset performance is a known fact, but the fact that a more restricted group actually is able to have a more restricted group's trading activity has a higher correlation is something new. We do find and highlight again that individual investors still generally suffer losses no matter their gender, as has been shown before. And but no matter that, female traders seem to outperform their male counterparts, although they do still suffer losses. And last but not least, I'd like to highlight the fact that this study, our R-squared values are pretty low. So the whole point of this study was not to build a predictive model, but more to test academic findings. There are some references, and thank you for listening.
Thank you very much. Thank you, Sofiya. Let me make my video as well. Okay. Thanks. So I just want to say, for questions, you can either activate your microphone or write in the chat. So feel free to do either or both. And we can start the Q&A. We have in total 20 minutes, but generally 10 minutes. It's what we expect for the question and answer. But let's see how the discussion proceeds. So, any question from the audience? I don't see anything in the chat yet.
Can I ask a question?
Sure.
Like Tommaso asked them. How are you? Can you see me? Can you hear me?
Yes.
Yes.
Okay. Yes, I mean, just as a personal impression, why there should be any difference between male traders and female traders? I mean, it's assuming similar backgrounds.
Well, this is basically the differences we assumed are based on a lot of other studies that have, for example, shown that female traders are a lot more risk averse. They adopt less aggressive investment strategies. They are more prone to the disposition effect that has already been hypothesized. Previous studies have also shown already that female traders tend to outperform male traders. And this is why we decided to test for a difference in the two groups.
I don't know much about, I mean, the philosophy of trading, let's say. But I was thinking, I had the idea, and that is just an idea that formed into my mind, that actually risk aversion was not particularly positive for profits, in the sense that, I mean, more risk adverse and less you make. So what you told me seems to be the opposite. As I said, I have no idea. I mean, it's just, I mean, it was an impression.
I mean, here we're not particularly saying that risk aversion is what generates better profits. It's more the use of a momentum strategy.
Okay.
Momentum does not have to be in correlation with risk aversion. It kind of, there was some sort of idea which made us test for preference towards momentum due to risk aversion, but it does not have to be correlated. That was more of a personal.
That's fine. But that's interesting in the sense that you are telling me that, and I mean, I'm not criticizing this at all, that for moment strategies, risk aversion seems to be, so risk prudence seems to be better than being less aggressive seems to be better.
If you are trading momentum from only based on our findings, yes. Okay. But this is solely based on our findings.
Yeah, that's okay. Interesting. Thank you.
Thank you, Tommaso. Thank you for the question. Any more questions from the audience? I guess personally, I have a follow-up question on what Tommaso was asking. So in terms of the literature, and I guess coming back to the question on why there should be any difference, I guess there could be some context for the culture of a given trader, but I guess I'm not an expert in gender studies, but there is no intrinsic gender element to trading per se, right? But again, I don't want to say anything completely at odds with the literature. So I guess coming back to the question is I guess you were answering with the risk aversion, but I guess one could ask again the question on why there should be any difference on risk aversion. So is there any more kind of detailed answer related to the background that traders may receive depending on their gender? Thank you.
Well, this is more, so in the paper, we do talk about this in the literature review, but this is more of psychological studies. So psychological studies have actually shown that in general, not even talking about trading, women are more afraid of negative outcomes than men. And so what's interesting is that since finance is an extremely male-dominated industry, basically women are, if we can say so, expected to perform less, like perform worse than men. So maybe that is what drives somewhat the risk aversion. First of all, psychological facts that they are already more afraid of negative outcomes. And then there is this idea that there's a lot, it's an extremely male-dominated field. They're expected to perform worse. So probably this leads to them being more risk averse. But it's a little more like, we didn't really go that much in detail since it's more psychological than of actual mathematical.
No, thank you very much. I mean, behavioral finance is definitely something we also study in different contexts. So, so I guess that's completely I guess within the assumption that are current, like that usually made about yeah, the irrationality sometimes, or kind of the behavioral component of a decision making. So no, absolutely, that's definitely something that I guess also from our context is something we are aware of. But thank you. We are. I am aware of, but I'm looking for the group in a way. No, thank you for the answer. I guess that also clarifies yeah, my question. So is there any other question from the audience on this point or other points from the study?
Oh, I think there was in the chat.
Thank you. Thank you very much. Yes, let me just read it out loud for maybe, no, so I was wondering, so this is for Jan, I was wondering if you had a chance to look into potential differences in trading experience between men and women in your data set. Is it conceivable that women decide to trade when they're reasonably certain they know what they're doing, while men just do it for it, go for it sooner? Secondly, was there any difference in how much the two genders invested? For instance, if experienced men invest only small amounts at first. I suppose there are too many such potential confounding variables to account for them all. Thank you for the question, Jan. I think there are a few questions actually in this message. Yes.
Okay, so first of all, we did not really look at experience in traders in our research, but I did read that in general, from other studies, it has been shown that generally women in trading activity are more experienced than men. So women that actually go into trading are generally more experienced in the field than their male colleagues. We did even conduct a very small experiment on this to see basically, we looked at age groups, whether, and generally male traders are younger than female traders. I'm not sure, but we could hypothesize that this would mean that female traders are maybe more experienced, or maybe they just enter into trading activity when they're older. But so yeah, we personally did not really test that much on this question. And differences in amounts, again, we did conduct a small experience on the differences in invested amounts, but that was only on I think a year, maximum a year. And in the data set, so from our broker, we did find that women generally invest higher amounts. So maybe that could suggest that maybe they're richer or more experienced, and that men invest smaller amounts due to them being inexperienced. But again, it's a hypothesis. It's something we could potentially follow up on, but I can only tell you what we found from a very small experiment on a very small time frame. So I don't think we can generalize on it, but yes, we did find that women generally invest higher amounts than men. Yes.
Thank you. Thanks, Jan. We cannot activate the mic, but it's thanking for the answer. We have still some time for other questions. If the audience has other questions, so we can still have a few minutes, if that's right for the speaker. I guess just a follow-up question on the Jan question. So the first one is it conceivable that women traders decide to trade when they're reasonably certain they know? I guess in quantitative terms, this may mean that they have a more statistically robust signal. So is this potentially something that one can investigate with your data set, you think? Or is so like actually understanding the signal.
More robust.
Yeah.
I mean, I don't think that from our data that will be possible. We only have information on past stock prices when it was purchased. Maybe if we connect dates and data, we can find something, but it's so huge that that would take a huge amount of time. Maybe potentially we could form connections, but like just from simply analyzing data, like I couldn't just sit down and write the code. I think we'd have to connect with dates. We'd have to look on the internet. Maybe there was some certain event that drove the price up or down, and that could not, that would take some time. It may potentially be possible to do.